Hello, finance enthusiasts. Today we're exploring the fascinating world of dividend portfolios. A dividend is essentially a slice of a company's earnings distributed to shareholders. It's a key element in investing, allowing you to reap the rewards of your investment without selling any shares. Now, a dividend portfolio, that's a collection of investments specifically chosen for their potential to generate regular dividend income. By the end of this video, you'll have a solid understanding of dividend portfolios and how they can work for you. So, what exactly are dividends and how do they work? Let's break it down. Essentially, dividends are a portion of a company's earnings that are paid out to shareholders. It's like a thank you gift from the company to its investors for their trust and support. Now, not all companies distribute dividends. It's a strategic decision made by the company's board of directors, and it depends on a few factors like the company's financial health, reinvestment opportunities, and industry norms. Here's how it works. Once a company has tallied up its earnings, it decides what portion of those earnings to keep for reinvestment and what portion to distribute as dividends. This distribution typically happens on a regular schedule, often quarterly, semi-annually, or annually. The exact amount you get is based on how many shares of the company you own. For instance, if a company declares a dividend of $2 per share and you own 50 shares, your dividend payout would be $100. But why do companies choose to give dividends? Well, it's a way to attract and retain investors. Dividends can be a sign of a company's financial well-being and stability. They can be particularly appealing to investors seeking a steady income stream, like retirees. However, it's also important to note that a company's decision not to pay dividends isn't necessarily a bad thing. It could mean they are reinvesting their profits back into the company for growth, which can also be beneficial for shareholders in the long term. So, in a nutshell, dividends are your slice of a company's profit pie, served up as a token of appreciation for your investment. They can provide a consistent income and are an important aspect to consider when choosing stocks for your portfolio. But remember, dividends aren't the only factor to consider. It's also crucial to look at the company's overall financial health, growth potential, and the price of its stock. Understanding dividends is the first step in building a successful dividend portfolio. Now that we know what dividends are, let's discuss why you might want to consider a dividend portfolio. A dividend portfolio offers a plethora of advantages to an investor. One of the most appealing aspects is the steady income stream it can provide. This is an attractive feature for people who are seeking to supplement their income, or those who are retired and need a consistent cash flow. Dividends can be a reliable source of income, especially when you invest in companies with a strong track record of paying dividends. In addition to the income aspect, a dividend portfolio has the potential for capital appreciation. This means that not only can you receive regular dividend payments, but the value of your investment can grow over time. Companies that pay dividends are typically well established with solid financials. These firms often see their stock prices rise over time, which can boost the overall value of your portfolio. But the benefits don't stop there. Another advantage of a dividend portfolio is the power of compounding through reinvestment. If you choose to reinvest your dividends, you essentially use your earnings to buy more shares of the company. Over time, this can significantly increase your holdings and potentially lead to even higher dividend payments in the future. This compounding effect can substantially accelerate the growth of your investment. Moreover, a dividend portfolio can offer a degree of protection in volatile markets. Dividend-paying companies are often more resilient during economic downturns. Even if the market price of the stock drops, you can still receive your dividend payment, providing a cushion against market volatility. Lastly, a dividend portfolio can provide a sense of financial independence. With a well-structured dividend portfolio, you may not have to rely on selling your investments to generate cash. Instead, the dividends themselves can provide the income you need. With these benefits, it's clear why dividend portfolios are a popular choice among investors. All right, you're sold on the idea of a dividend portfolio, but how do you go about building one? Let's get the show on the road. The first step in building a dividend portfolio is diversification. This is a term you've likely heard before, and for good reason. Diversification is the practice of spreading your investments across various sectors and companies to reduce risk. Think of it as not putting all your eggs in one basket. It's a way to protect your portfolio against the volatility of the market. Now, it's important to understand that diversification doesn't guarantee profits or protect against loss in declining markets. However, it can provide a reasonable level of protection against unnecessary risk. Next, we'll talk about company analysis. This is where you'll need to roll up your sleeves and do some homework. The goal here is to invest in companies with a history of stable earnings and a strong track record of dividend payments. Look for companies that are leaders in their industry, have a competitive advantage, and demonstrate solid financial health. For example, you might want to consider companies that have a low debt-to-equity ratio, a positive earnings per share growth, and a high return on equity. Now let's discuss dividend yield. This is the annual dividend payment from a company divided by the market value per share. It's usually expressed as a percentage. Higher dividend yields can be attractive, but they can also be a sign of a company in distress. So, it's crucial to balance the pursuit of high yields with an understanding of the company's overall financial health. Last, but certainly not least, let's touch on the importance of reinvesting dividends. Reinvesting is like adding fuel to the fire of compounding returns. It's taking the dividends you receive and using them to buy more shares of the company. Over time, this strategy can significantly increase the size and value of your portfolio. Most brokerage firms offer a feature known as a dividend reinvestment plan, or DRIP, which automatically reinvests your dividends for you. It's a convenient way to help your portfolio grow over time. So, to recap, diversify your investments, analyze companies thoroughly, be mindful of dividend yields, and consider reinvesting your dividends. And remember, investing in dividends isn't about chasing the highest yield. It's about finding reliable companies that will provide a steady income stream and potential for long-term growth. Now, it's time to put these pieces together and start building your dividend portfolio. But keep in mind, Rome wasn't built in a day, and neither will your portfolio be. It will take time, patience, and a willingness to learn from your mistakes. Remember, building a successful dividend portfolio doesn't happen overnight. It requires patience, analysis, and a long-term perspective. So let's get started on this journey together. While dividend portfolios have their perks, it's important to be aware of potential risks and considerations. Let's start with the risk of overexposure. When you lean too heavily into one sector, you're tying the fate of your portfolio to the performance of that sector. For instance, if most of your dividends come from the tech sector and it takes a hit, your income could plummet. Diversifying your portfolio across different sectors can help mitigate this risk. Next, let's discuss changes in company dividend policies. Remember, dividends are not guaranteed. Companies can reduce or even eliminate their dividends at any time, which could significantly impact your income stream. To navigate this, consider investing in companies with a history of stable or growing dividends. These are often established, profitable companies that have demonstrated their commitment to returning profits to shareholders. Market volatility is another risk to consider. The value of your shares can fluctuate dramatically due to economic changes, geopolitical events, or company-specific news. While dividends can provide some stability, they may not fully offset these fluctuations. In this case, a strategy known as dollar-cost averaging could help. This involves regularly investing a fixed dollar amount, regardless of share prices, which can help smooth out the impact of market volatility over time. There's also the risk of inflation. If the cost of living rises faster than your dividend income, your purchasing power could decline. One way to combat this is by investing in companies that regularly increase their dividends, helping your income keep pace with or even outpace inflation. Lastly, there's the risk of picking the wrong stocks. Even seasoned investors can make mistakes. To avoid this pitfall, consider diversifying your holdings and regularly reviewing and adjusting your portfolio based on performance and market conditions. A well-managed dividend portfolio can help mitigate these risks and provide a steady income stream. Keep in mind, though, that managing a dividend portfolio requires time, effort, and a sound understanding of the market. But with careful planning and execution, it's entirely possible to build a portfolio that provides a steady flow of income while managing these potential risks.